It's time for the Your Personal Bank Show with Ference Toth, financial literacy educator and speaker, entrepreneur, and chairman of the board of Bank Information. Take charge of your financial future with Your Personal Bank. Now here's Ference Toth.
Welcome to the Your Personal Bank Show. Today, I want to talk about getting advice from those that are not qualified to give it. And what do I mean by that? See, one of the situations I run into, fortunately not too often, but I'll talk to somebody or be introduced to the Your Personal Bank concept and understand, those of you who've been listening to the show for a while know this. This is a different way to think about money, a different approach. I call it a paradigm shift in thinking about money. See, the challenges that we run into is it's not commonly shared with the average individual. Your personal bank, using high cash value policies to maximize cash growth, access it through bank lines of credit when you access the funds and create positive arbitrage, is very common in the high finance world or the institutional investment world. Banks are very famous, very commonly use this. In fact, in our bank board meetings, we often discuss your personal bank policies and that type of thing as a norm. Okay, it's a very, very normal thing. The typical advisor, the typical financial advisor, and I'm not picking on anybody here, so please understand. The bottom line is they're just not exposed to it. Even myself, I've been in the financial industry for, I'm going on my 23rd year. And for the first 14-ish of those years, I was completely unaware of this concept. And it wasn't through me lack of doing anything or being out there or being involved or anything like that. I just wasn't exposed to this type of finance because I wasn't dealing with bank boards. I wasn't dealing with, corporate finance boards. I wasn't dealing, my typical client didn't own a family office. And what's a family office? Well, typically those are folks with 10 million liquid in assets and above, and often well above that. Some famous examples of family offices are Bill Gates has those kinds of things. Of course, Oprah and Michael Jordan are a couple of famous examples of where they run. It's a family office is basically a type of entity like a corporation or an LLC that's designed for investing for that family or that person. Okay, and again, to get into that realm where it makes sense financially, again, it typically takes a 10 million liquid and above for folks to do that or make that make sense. Well, I wasn't dealing in that realm. And neither are probably, 98, 99% of financial advisors or CPAs or attorneys or, any other professional that you want to pick. You know what I'm saying? So most of us are dealing with what's called in the financial industry, the retail market. That's the average investor, the average American, okay? So we're just not exposed to this. We're not made aware of it. It's not a common thing in the retail or the average American consumer base, we'll put it that way, from the financial world. So again, I'm not saying any of this to pick on anybody. I was just as guilty myself of not understanding. In fact, for years, well over a decade, whenever somebody would ask me about, do I need life insurance? I had bought into the buy term, invest rest mantra, like so many people have. And I would say things like, you've got plenty of assets, plenty of money, and you're retired or retiring. You don't need to spend money on life insurance, because it's just going to get more expensive each year as you get older and things like that. All the things that we all hear. What I was not aware of, but I didn't know, and what I want you to understand, the vast majority of financial advisors, CPAs, attorneys, whatnot, are also not aware of, because they're not exposed to this, is they're not aware that you can actually build significant cash value into a policy. We're not told that there are companies that have been paying 6% dividends every year for the last 25 plus years and have never missed a dividend since before the Civil War. Folks, that's one of the most common surprises I hear from people when they first reach out to me, and they'll say, hey, I had no idea that was the case, that those types of companies even existed. Folks, I want you to understand something. For well over a decade, as a financial advisor, I did, dealing with financial stuff and advising people on it and all that, I didn't know that either. And what I also want you to understand is I was average penny ante, I wasn't not doing anything. For 4 years, for example, of my first decade or so, I'm not saying this to brag, but I just want you to understand where I'm coming from. I was top 10 in the country at annuity sales, for example, for one of the top 2 annuity companies in the country. I did a lot of retirement planning back then. Had a lot of folks who were retired or retiring who were looking for guaranteed sources of income, eliminating market risk, wanting to create guaranteed income sources to supplement retirement. I had a lot of those types of clients and prospects and folks that I was meeting. So annuities, often were a great fit for those people. And again, I would get asked, should we look at life insurance? And again, I'm sad to say I said no, because I didn't understand all the things that life insurance can do. For one, another one a lot of people don't realize, again, the cash value growth, the significant cash value. Look, if I had known then that there were companies were paying 6% and higher dividends the last 25 years, and that money could be grown tax-free, accessed tax-free, and passed on to the heirs tax-free, I probably would have changed my tune, okay? Because that's a strong, significant, steady growth rate that somebody can have without market risk, which, by the way, was one of the very things many of my clients were looking for. Now, I'm not saying you shouldn't have all your money there, but for those that are looking to reduce market risk, this makes a lot of sense. It's a great diversification tool, obviously. But the other thing, to my chagrin, I should say, I wish I had known about sooner, is the ability to use some of the life insurance for long-term care expenses in case something comes up. This I knew. I knew long-term care was one of the biggest challenges, financially speaking, that retirees have. In fact, often it's said it's the most significant financial expense for the average retired couple. And again, I'm not saying this stuff to scare anyone, but the statistics are if you take a couple age 65, there's a 75% chance one of them is going to need long-term care, and the average cost, as of a couple of years ago, was over $250,000. Look, I ask people this all the time. If you had a $250,000 expense, would that eat into your finances? Would that cause a problem? Would that be a challenge, particularly for the surviving spouse? Often the answer is yes. And what I didn't know, going back a decade ago, is that life insurance could actually take care of that situation. And as I often say, look, it's built into these policies. If you need I can't think of a better way to address potential long-term care expenses than through a high cash value policy, because it's going to grow cash. And the idea is you want to earn those dividends and earn money and make it grow. But at the same time, there's a benefit, long-term care, there's a benefit where you can pay for long-term care expenses. It's a portion of the death benefit. It's an advance. And what I didn't know was if you needed it, you got it. And if you didn't, you didn't pay any extra for it. So what could be better than that? I mean, really. Look, when I was first introduced to this idea, I immediately understood the strengths and the benefits and how this could dramatically change people's financial futures. Oh, and let's not forget, the last part I didn't know was, wait a minute, you could set up a high cash value policy to build cash in it, and that would become an asset. That cash in the policy would be an asset that you actually could later borrow against. Actually, you can do it from day one. You can borrow against it, and the borrowing rate is lesser, it's lower than the dividend rate, or what you're earning, what you're getting paid. I didn't know that. I didn't know that was feasible. That was possible a decade ago. And if I had known that, I would have realized, and as soon as I was introduced to this, I did immediately realize, oh my gosh, if I could grow money, say at 5.75%, 6% dividends today, for example, and then access it from a bank line of credit and get charged 3 to 3.25% typically, that I would get to keep the difference. That bottom line is that would put more money in my pocket every single year for the rest of my life, even if I took the dollars and spent them. See, as a person in the financial industry, As an entrepreneur, I didn't know those things. Why? They were never introduced to me, for one. Nobody ever brought it to my attention. I told you earlier, I was one of the top producers, top 10 in the nation in annuities, multiple years in a row. Yet no one brought this to my attention. That's why I do the radio show, because I feel like it's a travesty that people don't know about this option. Many people have never been introduced to it, much less understand it. Far fewer understand it. And so you can understand my frustration when I have somebody, I meet with them, and this happened recently. Fortunately, thankfully, it doesn't happen very often, because a lot of my radio listeners, I got to admit, they've been listening, most of them, for quite some time before we actually reach out to me and before we actually have our first discussion. So a lot of these questions and a lot of these concerns and misunderstandings are cleared up. But occasionally I get somebody who decides, hey, this makes a lot of sense. We get the process started, show them how to get the positive arbitrage, how to grow their cash, reduce their taxes, reduce the market risk, create a monies available for long-term care expenses if they need them, all that stuff. And then they go to talk to somebody who is not qualified, frankly, to give them advice, because they're not qualified. They may have a license to give financial advice, like a CPA or a financial advisor or attorney, but they're not qualified in the way. What I mean by that is they don't have an understanding of this product or this system or this tool. They don't really have a firm grasp on it. And they're still, like I was a decade ago, stuck in the mantras and what we're told and in the comfort zone we're in, and don't realize that, you know what? There may just be another way. There may be a better way that I'm completely unaware of. So they'll go to their CPA or their attorney or their financial advisor or their brother-in-law, who knows, and they'll talk to them, hey, do you think I should purchase some insurance, basically, is what's often said, and it's going to grow some cash, and they try to explain it. But here's the problem. When people hear the term insurance, I've said this, shared this before, if there's a time somebody stops listening, turns off to the whole idea, and misses the point, it's this. Because they have a preconceived notion in their mind what insurance can do. And it's a very limited one. In fact, those types of people only view life insurance strictly as a death benefit protection tool. It can do nothing else but be, buy term, invest the rest. We've all heard that mantra. There's no other view of anything else it can do. And that's so far from the truth. It's laughable. But the problem is, and by the way, folks, I want you to understand this. Most of the people that are the worst offenders in terms of pigeonholing what insurance can do are financial advisors, CPAs, and attorneys. So here's what I'm going to tell you. Stay tuned in the next segment. I'm going to talk about some of the solutions to this and what I realized, and you should too.
For more information on Your Personal Bank, feel free to contact Ference at yourpersonalbank.com. Back to the Your Personal Bank Show with Ference Toth.
Welcome back to the Your Personal Bank Show. And today we're talking about getting advice from those that are really not qualified to give it. And what do I mean by that? Look, the person you may be talking to, and I'm talking specifically in terms of the Your Personal Bank concept. Again, as I shared in the last segment, this is not a concept that's commonly shared or known by the average person, average investor, nor the typical financial advisor, CPA, attorney, whatever. In the world of institutional investors, banks, corporate finance boards, family offices, this is quite common. But again, you're talking about, in the entire investment world, 1 or 2%. The rest, the vast majority, have little or no knowledge about this and have little or no exposure. So look, if you're a financial advisor, let's say, and I'm not here to pick on anyone in particular, but if you're a financial advisor, CPA, attorney, whatever, and somebody asks you about this personal bank concept, and you've either, one, maybe never heard of it at all, or maybe heard of it, know about it very, very, a very limited basis, which is most common, and somebody asks you your opinion about it, and they're a client or whatever, it's human nature. An advisor doesn't want to appear I mean, the client's asking for their advice. They don't want to appear that they don't know, right? So they're going to try, and human nature is they're going to try to answer the question, even though there's very limited or sometimes almost no knowledge really or experience about the topic. It is your personal bank is not something, again, that's known or used commonly by the average investor, the average person. It's very much in the top, 1-2% investor world, institutional investor world, and all that. So occasionally I'll get somebody who's been listening to the show or wants to look into this or whatever, and then gets advice from someone who may have the license to give advice, but frankly doesn't have the knowledge to capably give proper advice at all. And again, human nature gets in the way. Sometimes ego gets in the way, and they don't want to appear that they don't know. So when you don't know much about something or you're not familiar with something, what's the natural response in most cases? That's true for all of us. Well, typically it's negative, right? You don't want to appear that you don't know. You're an advisor. You want to, be smart, right? And you don't really know much about something, so it's easier to say, you don't really want to do that, or it's not a good fit for you, or those kinds of things, and really kind of try to dismiss it, not have to get into too much detail about it, and move on to something an arena that you are more familiar with. I run into that most often, like I said, with financial advisors, CPAs, and attorneys. And it's for all those reasons I just stated. They don't really know. But they don't want to really tell you they don't really know. They don't want to appear like they don't know. And so, they kind of they're negative towards it and try to dismiss it. The reality is, if somebody's giving advice on something and you're paying them for that advice, let's say, for example, that person obviously should be an expert in it. I mean, you would think so. And not only should they be an expert, they should have probably some significant amount of experience with it, and better still, personal experience with using that tool, whether it's good, bad, or ugly, right? That's the wisdom, is learning from other people's knowledge, other people's experience, right? And if a person you're asking has no experience with something or no knowledge with something or very limited at best, how can you get good advice from them? So I even said myself, as I shared in the first segment, I've been in the financial industry going on 23 years. The first decade and a half, I knew nothing about this concept. I had never been exposed to it, even though I was one of the top 10 advisors in the country for annuities, for example, by one of the top 2 companies in the country. So I was out there doing a lot of business, meeting with a lot of clients, helping a lot of people. I feel good about all that. But what I don't feel good about is when they asked me questions about life insurance back then. I was a licensed life insurance agent who had never even submitted an application, a life insurance application, that is. Plenty of annuity apps. And what a lot of people don't realize is that's the norm. A lot of people don't realize, and this is a sad part too, I saw a study not too long ago that 90% of licensed insurance agents have never even submitted a life insurance application in their career. Not one. And many of these are active agents doing business, doing financial business, but they have not submitted a single life insurance application in their career. Now, should those people be giving advice on life insurance? They have a license, right? They're licensed. They can sell it. They can do whatever. Should they really be giving advice about life insurance? Let's be real. The answer is obvious. No way. No how. I shouldn't have said anything to those people. Yet, I'm guilty of the same thing back then. I wasn't really aware, didn't know, and gave the best advice I thought I knew at the time. Sadly, it wasn't correct many times. And let's be real. If a financial person, a licensed insurance agent who may have other licenses, or maybe a CPA also, or maybe an attorney also, or whatever, has never submitted an application, a life insurance app, should they be giving advice? We know the answer. So maybe one of the questions that you as a consumer can do, as a customer, the person asking for the advice can do is, if you're asking questions, really this applies for anything, frankly. If you're looking for advice from someone isn't it a good idea maybe to ask them about how much experience they really have about that thing that you're asking about? That only just makes logical sense, yet many of us just assume they do when in reality they don't. Because they have a license or they have a plaque or they sit in a fancy office, and you know what I'm trying to say, okay? And I'm not here to pick on anybody in particular. I'm just saying this is human nature. This is normal. Here's the other thing. Out of those, remember, 90% of licensed life insurance agents have never submitted a life insurance application in their career. What does that mean? They got the license to steer people to other business so they can say they're qualified to do that, or they many times they're really annuity salespeople. You have to get an insurance license to sell annuities. And to be frank with you, they're two different animals. They're different night and day. There really should be a life insurance license, in my opinion, and an annuity license, and they should be two different things. They almost have nothing to do with each other, yet people get a life insurance license to sell annuities. And, through experience, they can get qualified, but when you're a new insurance agent and no experience, you're really not qualified to give advice because there's no experience, knowledge, or anything. Plus, the test has so few questions on annuities, it's ridiculous. But yet, there's far more annuity people than there are life insurance. I mean, that's just a common fact, very common. So when we narrow this stuff down and start realizing that 90% of licensed life insurance people have never submitted an application, that makes them unqualified, in my opinion, right off the gate, to advise or discuss life insurance in any form or fashion. Because you can't tell me every single person they meet, it's not a good fit. That just doesn't even make logical sense, okay? It is a good fit for certain people, for sure. The amount of people can be debated, but certainly for some. And then if they really are an annuity person, or really they're a financial advisor who deals with money under management, they're really not a life insurance person, they're really not, and they don't deal with it, they're not qualified either. Let me talk about a few other situations, so stay tuned.
For more information on Your Personal Bank, feel free to contact Ference at yourpersonalbank.com. Back to the Your Personal Bank Show with Ference Toth.
Welcome back to the Your Personal Bank Show. Today I'm talking about people that are giving advice, particularly on the Your Personal Bank concept, that have no business giving that advice. You see, it's not that they're not licensed to give financial advice. Many are. Many are financial advisors, CPAs, attorneys, things like that. But what I'm trying to say is they have little or no knowledge about this concept. And by giving any advice, good, bad, or indifferent, frankly, they're not qualified to do so, yet I often run into many of them that do. And I'm not saying this as a sour grapes kind of thing. I'm sharing this more as a help for you. Look, whether it applies to Your Personal Bank concept and you're asking somebody, whether it's a financial advisor, a CPA, an attorney, your brother-in-law, or anybody else for that matter, and it's not even asking them advice about the personal bank concept, but if you're asking somebody advice on, anything, it's just smart, it's wise to find out what level of knowledge and experience they have with the thing that you're asking them about. And as I've shared earlier, when you look at roughly upwards of 90% of licensed life insurance agents have never submitted an application in their career, how many of them are really qualified to give any advice on it? Now, they may have licenses to do other things also. That's fine. But should they really be giving advice on that specific thing, life insurance in general? And there's far more licensed agents who actually sell annuities instead of life insurance. I mean, it's like 10-to-1 ratios almost. I've seen different studies and things like that, significantly more. So again, they're really more annuity agents, they're really not life agents, even though they have the life insurance license. It's a problem with our industry. They should be two different licenses, again, in my opinion. The other part is, for those that actually have done life insurance applications, insurance agents, the majority of those are just selling term and nothing else. And folks, there are 5 different types of insurance out there. There's term insurance, of course. There's variable life. There's universal life. There's index universal life. And there's whole life. And all 5 of those actually have strengths and weaknesses which is another pet peeve of mine. If somebody says this is bad or that is bad, really that person is not giving advice. All they're doing is sharing you with they're sharing their personal bias with you. They're personally biased against something or for something, okay? My point is that's not advice, okay? And we hear that often. We hear that so often. People say, oh, this is bad or this is good. There's 5 different types of insurance. If you're looking for that, it depends on what your goals are, what you're trying to accomplish, what your risk tolerance is. All those various things, various factors that come into play to determine which type is bad. So the very statement, buy term, invest the rest, is a biased statement. It's saying all insurance is bad except term, and you should invest the rest. Well, that is not 100% true 100% of the time. There are situations, any reasonable person can argue and realize that there are times when different types of insurance policies are important. Like if somebody wants to make sure they have a death benefit in place that's going to last their lifetime. That's one. Another one is if they want to have monies for long-term care expenses. Life insurance can be one of the best ways to cover that. Like I say often all the time, it's one of the best ways to do that because, well, if you need it, you got it. And if you don't, you didn't pay extra for it. So really, what could be better than that if you're looking for some protection that way? But again, like many banks and corporate finance boards and various wealthy people understand, you can build significant wealth with high cash value life, which again is a type that most people are not familiar with. You can get consistent dividend growth, 6% plus, even today, every year, never miss dividends since literally before the Civil War. There's also index options where you can get double-digit returns in good market years without any downside market risk. Also, that's powerful, folks. I can show you products that have average 8.5% average rate of return over the last 25 years and income tax free on top of it without any downside market risk. Look, if you can invest an average an 8.5%, let's say the last 25 years, you had invested an average an 8.5% return tax free or after tax, let's say, most people would be pretty darn satisfied with that. When you add on top of that, you never have a down year. In other words, every year you go, it's stair-step approach. Every year you get a gain, you keep it. So if the market corrects, it doesn't matter. You're fine. That's powerful. So there's a lot of things to this. But the last one is the positive arbitrage. And I'm going to talk more about that in the next segment because this is where your personal bank separates itself from other financial tools. It gives you the ability to earn interest on money you spent. Look, you can allocate dollars elsewhere, and you can keep the difference of the interest you're earning versus the interest you're getting charged. The dividends you're earning versus the interest you're getting charged. You keep the difference, even on dollars that are spent, which means you have more money in your pocket. So I'm going to recommend strongly, stay tuned. We're going to talk about that more in the next segment, so don't miss it.
For more information on Your Personal Bank, feel free to contact Ference at yourpersonalbank.com. Back to the Your Personal Bank Show with Ference Toth.
Okay, welcome back. We're going to wrap this up today, but what we're talking about is people that are giving advice regarding their personal bank concept that frankly, well, have no business giving that advice. And again, what do I mean by that? Look, they may have a license, for example, to give that advice. But if the person doesn't have the experience or knowledge, then they really shouldn't be giving the advice, well, at all, good or bad, frankly. And we oftentimes, when we ask advice from people like I said, like financial advisors, CPAs, and attorneys, we often assume that they understand the Your Personal Bank concept along with other financial tools, and they're giving us a well-reasoned answer when many times, I found this to be true quite often, they have little or no knowledge or understanding about how this works. And when somebody doesn't understand something or has little experience or knowledge about it, well, general human nature is just be negative, right? And like I said, I think and I'm saying this not as a sour grapes thing. I'm saying this to help people because because I've said before, if you're going to ask advice on any topic, on anything of someone, you need to find out what their knowledge and experience level is with it first before you ask the advice. Like, how much, I was looking at this personal bank thing. Maybe a good question to ask is, how familiar are you with this? How many clients have you worked with on this, and have you ever recommended it to anyone or done it with anyone? Because if somebody's just giving you all this is good and that's bad all the time, 100% of the time, see, nothing's true 100% of the time, is it? In other words, no financial tool is good for 100% of the people, and no financial tool is bad for 100% of the people, or is it? If somebody does that, well, that's just their personal bias, isn't it? So ask, look, what's your experience with this? What's your knowledge? How much have you worked with? How long have you known about this? How many clients have you assisted with setting these things up? How has it worked out? Do you use it yourself? Things like that. Because here's why that's so important. If you think about it a minute, if you ask somebody, should I set up this insurance policy to build cash value and access the funds from a bank line? Again, most people on the surface are going to be negative to it because they don't think of insurance as an investment tool. One, and two, borrowing in general is bad, right? That's what we're taught, most of us. You don't want to ever borrow. So there's 2 strikes, boom. No, that's bad. You don't want to do that. It's not a good fit for you, whatever is said. But what if you phrased it this way? You said, do you think I should set up this account that I can grow the money and it grows tax-free and I can access and use it tax-free? Ooh, that's interesting. It has downside guarantees. I can either set up a steady Eddie account where it's growing at 6% dividends or greater every single year for the last 25 plus years, and they've never missed a dividend since before the Civil War. So I want good, steady, consistent dividends. Do you think that would be important? Do you think I should do that? That sounds pretty good for a lot of people. What if, those dividends could be tax-free? What if I could invest into an index account where the money goes up? When the markets go up, I can get double-digit returns on strong years, but never lose on the bad years. And the average return over the last 25 years has been 8.5%. So 8.5% after tax or tax-free. Well, that's pretty good for a lot of people. That's pretty darn strong. What about if I could set up an account that if I needed some money to cover long-term care expenses, the money would be there. I'd have extra dollars there if I needed it. But if I don't need it, I didn't pay any extra for it. Okay, that sounds generally pretty positive for most folks, right? What if I set up an account where if something happened to me prematurely and I passed away early, there'd be a nice big check to my loved ones or heirs or people that I care about. I want to make sure they're taken care of if I'm not here. I mean, that's the general premise of life insurance, right? So that's generally a good thing for most people. And then the last one, let me give you this one. Well, what if I set up an account where the money grew? It had underlying guarantees, so I knew it was going to grow and it was going to be there every single year. And it was going to grow faster, and when I wanted to access it, I could access it, use it as collateral for a bank line. So the cash in this account is collateral for a loan, and the interest in the loan is less than what I'm earning. So in other words, I'm keeping the difference. So even if I take the money from the bank line, my money still grows. I keep the difference. Do you think I should look into something like that? Again, the answer is going to be overwhelmingly favorable, right? In most cases. Oh, by the way, that positive arbitrage situation, because that's what it is. I get asked that all the time. What is positive arbitrage? It's not a complicated concept. It's your money's earning more in one account than you're getting charged in another when you access it. And you're keeping the difference. That's positive arbitrage. And today, most of our clients are making 2.5% to 3% positive arbitrage on their accounts. So if you said, look, to this advisor that you're asking advice from, hey, I can set it up in this account. I can access the funds. It's mostly liquid, day one, 100% liquid in a few years. And I can use that money to invest in other stuff. And basically, it's going to increase my rate of return on investments by 2-3% every year, the rest of my life. And it's going to be tax-free. I've got high liquidity. I've got guarantees. And money, there's extra money available in case I needed it for long-term care. And if something happens to me, again, the big chunk, more than I ever contribute, goes to my heirs. What do you think the response would be from most advisors if you asked them those questions? And you see, that's what I'm trying to say. If you understand how this tool works, if you truly look at it and understand how it works, it's hard to see many situations where the response would be negative. In fact, your personal bank is one of the financial tools that I've seen in my career that works for most everyone. In fact, it's the opposite of most financial tools. Most financial tools, there's a certain set of parameters it makes a lot of sense for, right? With this, it's kind of like the Swiss Army knife financial tools because it can do so many things. For example, again, somebody wants to look to reduce market risk, for example. They're concerned about the stock market maybe going, we've been hitting all-time highs, right? There's a lot of people concerned about that. Well, this can be an alternative to that. That can make a lot of sense. What about somebody who's looking to reduce taxes? A lot of people are concerned about future tax rates. Our current administration has been sharing the number of ways they want to raise our taxes. Well, if you can reduce your tax liability, doesn't that make sense? Of course it does. All right. So a lot of people are concerned about that. A lot of people are using this they say, I want to create an income source that I know is going to be there to supplement retirement, either now or down the road. Again, this can be a great tool for that. All right. I get a lot of investors, whether they're stock market investors, real estate investors, cryptocurrencies, you name it. I've got folks all over the board. All right. Precious metals, whatever, you name it. And they say, look, I want to put the money into this account and then access it from the bank line and invest in the things I want to invest in and pick up that positive arbitrage. Great tool for that. And again, I want to protect from long-term care expenses, but I don't want to pay a bunch of money for that. Well, awesome tool to accomplish that. Again, my point is there's so many different things this can do. It becomes a fit, and most people don't need just one of those things, do they? In fact, that's one of the questions I ask people. Many of the questions I ask people all the time is, well, what are your goals? What are your concerns? What do you want to accomplish? What are you concerned about? And oftentimes, your personal bank can accomplish several of their objectives simultaneously. So that's what's so cool about how this works. So I think you can see where maybe there's a little frustration in my voice. There is. When I have somebody who sees the idea, realizes, hey, this might be a good idea for me, they pursue it, get everything going, and then, again, ask the advice of someone who probably, frankly, has no business giving advice on this because, well, frankly, they have no experience or knowledge with this and don't really understand what it can do and don't realize that, well, you know what? There's a lot more that, for example, insurance products can do, structured the right way, than just be a death benefit protection tool. There's so much more it can do, yet so few people use it to its full capacity and what it's capable of accomplishing that I think it's almost criminal that so few advisors even are aware of that, much less bring it up to people and help them understand that you can reduce market risk and taxes and increase your cash, increase your rate of returns on whatever you're doing and protect from long-term care and protect your loved ones and do all those things all at the same time. That's what your personal bank does. That's how we help people enhance their financial future, well, dramatically in many cases. I'll give you one quick example. A client of mine I've been working with for a number of years, and he's a real big real estate investor. And he's been funding monies into his personal bank policy and building a larger and larger line of credit. And one of the things I showed him, and he has the funds to work with to do all this. So I said, hey, his anniversary date's coming up, and he hadn't quite put all the money in this year that he could contribute to it. Folks, there's a tremendous amount of flexibility of how much you can fund into these things each year. And that's something many people don't realize. Well, he had basically funded a little over the minimum. And he realized, hey, I could put a whole lot more in this policy year. And by doing so, what happens? Well, he earns more dividends, right? Basically, he asked me the question. I said, well, do you want to earn dividends on this amount or a larger amount, which means you get more dividends, right? He said, well, that's a no-brainer. And he has the money to work with, like I said. I said, oh, by the way, that increases your bank line also, and your access to more money than he's a real estate investor to purchase real estate and still pick up the positive arbitrage, which in his case is about 2.5%. Okay? So what does that mean? He's adding 2.5% return on all of his investments over and above what he's already making. So if his rate of return is 10% on a particular real estate deal, for example, he's now making 12.5%. Look, do you want to make 10% or 12.5% on an investment? I mean, that's pretty obvious, right? So my point is, he said, look, I need to put that extra money in there so I get the extra dividend, yep, and get the higher bank line, and I have more money to work with, access, and get more positive arbitrage on these deals. I said, yes. I said, here's another thing. Because his anniversary date is coming up in a few weeks, he can fully fund as much as he wants to in the following year, all up front if he wants to, which means he dumps a bunch of money, in essence, almost 2 years' worth of contributions at one time, which would dramatically increase his cash, dramatically increase his dividends, dramatically increase his bank line, and dramatically increase his positive arbitrage then. In other words, he's got enough cash now by doing all this, which he's doing. He'll be able to purchase a house outright cash now after about 3-4 years of contributions. And when he buys that house cash from the bank line, he's going to pick up 2.5% positive arbitrage. And then when he fixes that house up and sells it or does whatever he does or rents it out or whatever he's going to end up doing, whatever his rate of return is, he's going to enhance that by 2.5%. Now, for those of you that don't realize this, 2.5% is significant increase on an average rate of return. Why? Well, if your average rate of return on an investment happens to be 10% annually, you make 10% average rate of return on investment, and you then increase that rate of return by 2.5%, you just increased your rate of return by an extra 25%. A 25% increase in your profitability. Look, you look at any business, and I met with a business owner, his CFO and CEO last week, and showed them this, and they have great interest in incorporating this with their business. And I pointed out, I looked at the CFO and said, if you increase your bottom line profit by 20-25%, what would your business look like? And I mean, their eyes started bugging out. They started getting excited because they realized, holy cow, this is huge. This is massive. This can make a massive impact on the profitability of their business. And many, many other business owners have done that over the years, investors and just average folks like you and I. So as always, contact me at yourpersonalbank.com for more information, and stay tuned to the Your Personal Bank Show.
For more information on Your Personal Bank, feel free to contact Ference at yourpersonalbank.com. This show is designed to provide accurate and authoritative information. The presenter and guest on this program do not engage in legal, accounting, or tax advice. Professional advice regarding your situation should be sought if required. Products and riders may have limitations and may not be available in all states. Excessive unpaid loans may affect performance. Distributions may become taxable if not managed properly. Replacements may not be suitable for everyone. There may be charges when replacing coverage. Compare when considering a replacement. Dividend rates and bank line of credit rates may change. Contact yourpersonalbank.com for current rates.